Well, the big story this evening, of course, is the SEBI releasing a consultation paper to curb speculation in the F&O trading. Now, Sajid Mangat is joining us in the studio with more details. Sajid, top of what we can understand of this paper that has been released is that SEBI has listed about 7 steps, including increasing the minimum contract size for F&O to 20 lakhs. And limiting weekly options contract. Give us more details of what you understand of what has been said in the paper.
To set the context here, we've been looking at most of the regulators talking about the fact that there's excessive speculation which is there in the derivative market, and the fact that a lot of money is from the household saving is now getting channelized into the derivative market, and that's creating a issue for the regulator on a macro side. And that's the reason why we had SEBI talking about it, and then SEBI under the in the secondary market advisory committee, which looks into the market policies, created an expert working group which consisted of brokers, exchanges, experts to look at how to curb this entire excessive speculation, and they came out with a regulation. And now SEBI has come out with a consultation paper, which is a public process for any policy decision made by the regulator, and they have come out with 7 key things. The first being that the strike intervals. Now, for people, strike intervals are those, if the index is say for at 100, at what interval you have the contracts available to the investor. That's a strike interval which we are talking about here. And SEBI says that while strike intervals will be smaller, up to 4% either ways of the index, it will expand post 4%, and that would mean that the cost will also go up for the investors who are looking at taking positions beyond 4% from the index level at any point in time. The second one is basically the number of strikes that's available. Earlier, the regulation was that 35 strikes were available on either side of the index, 35 on the higher side and 35 on the lower side. They have now reduced it to 50 strikes at any given point in time, and it will be done it will be adjusted on a daily basis by the regulator if this proposal goes through. The third one was the upfront margins. Now, when you do an trade in the market, you have to pay margins. In the case of options, especially, many of the clearing members were paying margins to the stock exchange and clearing corporation. Now it has been made mandatory for the clients who are trading in options to give upfront margins to the stock exchange and clearing corporations, and that is something would be much more hurting, because today, if you are trading in an options market, at the end of the day, you would end up paying a margin on it. But now, before you make a trade, you have to put the money upfront to the stock exchange or clearing corporation there. There is another thing which has been brought in, which is a calendar spread for people to understand. It's basically taking a position in current month by selling current month and then buying in the next month. And the spread which is there had a lower margin component. Now they are doing away with calendar spread on expiry day, which basically means that speculation and arbitrage which they were trying to do, they're trying to bring down that thing. The biggest impact would be the minimum contract size for index derivatives. Any new stock or any index which is going to be introduced will have a lot size of between 15 to 20 lakh rupees. Now, to give a perspective, today it is between 5 to 10 lakhs, so almost doubling of the lot size which is there, and this lot size will be increased to 25 to 30 lakhs after 6 months of the introduction of the contract. So basically what the regulator is making 3x more expensive for retail investors to come and trade in the market there. There is some bad news for the stock exchanges as well, because some of the products of stock exchanges are going to be rationalized. Like NSE had 3 products, BSE had 2 products, which were weekly option expiries. Now each exchange will be given 1 benchmark to expire a week. That means there will be only 2 weekly expiries, one from NSE and one from the BSE. There's other measures which is increasing in margins and all, which makes life little tougher and higher and expensive for retail investors. The big thing is that in FY24, there were around 92.4 lakh investors who were investing in the futures and options market. 85% of them were making losses, and these losses were to the tune of over 50,000 crores, which SEBI's concern is that only 15 out of every 100 were making some kind of profit, and the profits were also being taken by mostly by the proprietary traders. So the impact of this would be on immediate volumes, which is coming from retail investors and proprietary investors, which is there. So, if you look at some of the NSE data, it shows that, some of the average ticket size or the trade size, it was around 6,000 rupees odd in the options market. Now, if this rules comes into play, it will go up to 3x or 4x the size, and that would mean that it becomes much more expensive to trade in an options market and speculate in this market.
Right, absolutely. Sajid, do stay with us. Also joining us on the broadcast is Mr. J.N. Gupta. He's the former ED of SEBI. And also joining us is Deven Choksi, the MD of KR Choksi Shares and Securities. Mr. Choksi, to you first. What do you make of these guardrails, so to say, that have been put in place, or likely rather to be put in place by SEBI?
Yeah, good evening. Well, I think the intention of curbing the speculation is not denied under the proposal which has been brought out. However, I think the strong apprehension whether it will probably result into the reduction in speculation, answer is no. There is going to be a side effect to this. On one side, we are talking about increasing the size of the market lot. I think increasing the size of the market lot means that I think there is going to be a significantly high amount of encouragement to the people to go to dabba trading. Second most outcome would be that instead of trading in this derivative market, the market participant would start trading into small cap and mid cap stocks where the liquidity driven push is easy to obtain. So honestly, I think those liquidity-driven push, I think, which are basically going to be the resultant outcome in the small and mid-cap stocks, will probably make the valuation of the small mid-cap stocks even more crazier. And last but not the least, I think by creating the size of the contract, I think, which is larger, we are forgetting one thing, that today the market capitalization is $5.5 trillion. This market capitalization in the next 10 years is going to become $12 to $15 trillion. If this is going to be the reality, then whatever may be the size of this market lot that you are creating today, you'll only be increasing day by day going forward. So that is not a solution. That is not a liquidity created solution in the marketplace. I think you may curb the speculation on one side, but whether it will result into liquidity creation in the marketplace, I think the answer is big no. So I think the proposals are proposals. Maybe I think they have to be discussed in a fair manner, so that at least I think the resultant outcome can come as a win-win for both, curbing the speculation as well as increasing the liquidity in the markets.
Even by, if you look at some of the statistics which is available on the NSE, the average trade size in the options market for retail is around 6,000 rupees. Do you think that trade size will now have to go significantly higher if they want to continue trading in the options market?
So the retail will not come to options market, Sajid. I think that is a simple answer. And if you create the hurdle, I think they will not come to option market, but I think they will go to the other markets, which I just now explained. And that is going to be even more dangerous. So I don't think that I think one has solved the problem in totality. One has possibly tried to create a speed breaker on the road so that the speed comes down. But I don't think that the problem is solved.
A shift of volumes from options market to, as you said, to the cash market, especially in the mid cap and small cap, isn't it little better than the kind of speculation which was happening in the options market?
100% better, but at the same time, I think those small and mid cap stocks on which I think this volume will get shifted to, they will go into a crazy drive. I think they will probably command valuations which are going to be even more crazier. Because understand one thing, that small and mid cap stocks today, the rally is driven purely by the liquidity constraint. Today these stocks do not offer enough amount of liquidity, and as a result of which people with money back, they play around in this particular counters, create narratives, and ultimately create crazy valuations. So this is not going to stop. On the contrary, I think it will make even genuine investors affected in the stock market, because I think the valuations will go completely crazy in some of the small and mid-cap stocks where the liquidity is a concern.